Hi, my name is Auth. I'm one of the M&A leaders here at Black Diamond Capital Advisory Firm. Today we're going to talk about debt service coverage ratios and how to service your debt and make a profit when purchasing a business. So what do you need to know about debt service coverage ratios? Coverage ratios are a credit metric that are used by banks and lenders to better assess a borrower's ability to service debt when analyzing a company's operating cash flow. Usually the higher the better. Most lenders, they're going to range from about 1.25 up to 1.5 in terms of a coverage ratio that they want. And each one's going to be different based off of their credit appetite, the risk appetite, and the overall market and how they see it. It's important as a borrower to understand the business's cash flow and understand your ability to make a debt service payment each and every month, not just on an annual basis when looking at a deal. So how can you do it? I think there's about 5 steps here that you need to look at to be able to understand the coverage ratios and how you can make a debt service payment each and every month when owning a business going forward. So step 1 is to analyze the company's historical financials. So if you're looking at a deal, this isn't a cursory review, it's an in-depth look at all 3 statements. This is the profit and loss to understand the company's profitability. This is a balance sheet to understand the current assets, the current liabilities, and the current ownership of the business at any given time. And then of course the cash flow statement to better understand, hey, where is the cash coming in, how from operating activities, where's the cash coming out, so you understand what is coming in and what's going on the cash side. So step 2 for this is to calculate the debt service coverage ratio. So this is a pretty simple formula. It's just taking the current income and dividing it by the debt service. So imagine a business making $1 million in profit and there's $1 million in debt service. That would be a 1 coverage ratio. Anything lower than a 1, you're not going to be making a profit. You're going to be losing money, paying off lenders. But the goal is to go higher, of course. If there's a minimum requirement for a bank, for instance, and most other lenders, it's going to, keep you in the profit in that regard. But of course, you want to go higher and higher. I mean, 2+ is always great as you get more and more profitable each and every year. Step 3 to this is understand the market. Understand, hey, how can I go and make more revenue? How can I understand the costs? Where's my risks? Understand the whole sense of it and understand your experience in it and how you can better benefit a company going forward. Of course, step 4 is the purchase itself and negotiations there, and understand where you have to use debt, how much. So this can come through a few factors. If you bring cash, of course, you're not going to have to bring any debt. So the more cash you bring, the better. And of course, the price. So if you're able to negotiate certain functions of the price, whether it be lower or seller finance or earn out, however it may be, if you can reduce your risk there of less debt, of course, you're going to be a better coverage ratio in that regard as well. And of course, step 5, have a great solid business plan. Understand how the strategies and steps you're going to take each and every month to help grow the business to be able to make debt service payments going forward. Buying a business is a significant investment. Of course, do your homework, understand the financials, understand the business, and thank you for watching. If you're in the market for buying or selling a business, feel free to reach out, and thank you for your time.